Here are my son's beloved marbles. This one, a couple of them are made of amethyst. Maybe altogether these are worth a couple of bucks. If you offered me $20 for them, I would not sell. But if you offered me $1,000, I'd sell it to you in a heartbeat and brave my son's tears. So these marbles, they represent GameStop stock, which has a tangible value, much like the marbles do. And the market will determine that price. Now, sometimes a stock becomes so out of whack with its true intrinsic value that people will say, I don't know, this is valued too highly, let's bet against it. That is called shorting a stock. And this is what the hedge funds with Melvin Capital did. You are betting that the stock price grows shorter, not taller. Taller they lose, short. When you short something, you bet that the price goes shorter. Now, let's say you have a smallish company like GameStop, and there are a limited amount of these marbles. It's not like Apple, a whole huge sea of marbles of a $2 trillion company. This is much more easy to manipulate. What these hedge fund companies then do is make a bet that the company is overvalued and the shares will drop. So when you short a company, you are borrowing shares from somebody else and selling them on the open market with the intention of purchasing the stock at a lower price. However, you do have to replace the shares. You are legally obligated to do so. So if, for example, you guess wrong and a stock goes from $10 to $100 and you get caught up on that, you might be forced to buy back at $100. And if you don't have the cash on hand, the brokerage house will automatically do that for you. And that's called a short squeeze, when automatic purchases of the stock force the price higher because the demand, as more buy orders come in, the demand for the stock rises. That's simple supply and demand. The Reddit community, Wall Street Bets, noted that GameStop was heavily shorted by these voracious hedge funds, and they wanted to exact a toll on them. Now, you might ask, what do people have against those who are just betting that a company is overvalued and that the stock price would fall? There is social utility in that, in terms of the fact that people then are able to unearth frauds, as they did with Enron and WorldCom and other companies, and then they make money doing so before other investors get suckered into the scam. The reason is because these hedge funds with multi-billion dollars are not just betting that the company is overvalued, which is fine. I mean, that's like me taking a bet on the upcoming Super Bowl and somebody says that they believe that Tampa Bay and Tom Brady are going to beat Kansas City by more than 20 points. I'm going to say that you're overestimating the value of Tampa Bay in the game, and I'm gladly going to take that bet. So I'm betting against you. There's nothing inherently wrong with that. But what some dishonest hedge fund managers would do, having made that bet, is create, the night before the game, give the entire offensive line of the Tampa Bay Bucks food poisoning. Look, this is not something that you or I have the capability or the desire to do. But when these hedge funds, who have the cash on hand and the egos necessary to enact such a plan, when they have a $100 million bet on the Super Bowl, wouldn't it, if they're only looking at it from a fiscal standpoint, be worth it to spend $1 million to ensure that one of the offenses shows up to game day vomiting all over the field? Do you not think that that would enhance the probability that they're going to win their bet? So the question is, how do they do this in the context of stock? One thing that they do is they offer some incentives, be it cash or otherwise, for media outlets to plant negative stories about the company, which, by the way, they absolutely did to Elon Musk and Tesla in an effort to sow doubt about the future of the company, to get other investors to sell their shares, driving the price of the stock down, making people think twice, for example, about buying a Tesla Model S, because maybe the company is not going to be around, depriving then the company of the lifeblood necessary to support itself, making it necessary to raise capital at higher rates. And so maybe they just nudge regulators, possibly with a huge stack of bills, not alluding to anything specific, and they get regulators to open up a fruitless investigation into the company and their practices, which of course then scares off investors, scares off financing, and once again greatly increases the odds that their bet is going to pay off. And they're going to reap the massive profits associated with that. They don't give a darn about the workers that are going to lose their jobs, go on the unemployment line, the resulting depressions that they're going to suffer from, the investors from whom they are stealing the capital that they originally supplied to, for example, Tesla, the suppliers that are contracted to provide the materials needed to build the cars. These hedge funds have absolutely in the past destroyed the hard work of good companies and diligent people so that they would reap financial gain. They came awfully close to helping to destroy Tesla, which has done nothing but innovate and make the world a more livable, better, and more fun place. So yes, it's absolutely understandable that many people on Wall Street bets and otherwise would have a negative association and negative feelings towards the hedge funds that behaved in such a parasitic manner, that drove companies under, that essentially stole from everybody to fund their multiple houses, lavish vacations, and private yachts. This is totally understandable. And of course, when you have these feelings, you have the desire to strike back. So that's what Wall Street Bets users saw. They saw an opportunity and they piled their money into GameStop. And many of them did so with the expressed intent of just sticking it to the man, sticking it in this case to Melvin Capital, the fund that was most at risk due to their GameStop exposure. And because, again, unlike Apple, there weren't a lot of these marbles to buy, the supply was not overwhelming, and they could actually manipulate collectively the price of the stock by just piling in the buy orders. The share price starts to rise, and this in turn increases the daily fees associated with being short for the hedge fund. Now, the original stated goal was to bid the price of the shares up so high that because Melvin Capital had so much exposure, they would be forced to cover their positions at much, much higher prices and potentially bankrupt the firm, much as they've done to other companies that actually have produced something. Again, I understand where the anger and ire towards them is coming from. So were they successful? In my estimation, the answer is somewhat. There were two factors that kept them from total annihilation of Melvin Capital. Number one, Melvin got loans from their hedge fund buddies so that they were able to come up with the capital. They claim to have covered their positions. Honestly, I have my doubts about that. Yes, Melvin definitely did pay a steep price for the capital injection into the fund, but the idea that they covered at what virtually everyone agrees is 10 times what the company is actually worth is very dubious in my mind. What they were doing by announcing that they had covered their position is they were trying to give the Redditors an excuse to start selling so that they could slowly start exiting their position and drive the price of the stock down and then keep some of the short positions so that they would get a huge profit. But they were attempting to get the pressure of the boot that truly was on their neck removed. Now, another way that they were able to do this was the app RobinHood, which was the primary way that many of these buyers from Wall Street Bets were purchasing the stock. They restricted purchases. And I'm not 100% sure of this, but it is likely something worked out between the big hedge funds and the regulators, or just between RobinHood and Citadel, which are the people that gave Melvin Capital the cash injection. Now, interestingly enough, RobinHood sends the orders to Citadel. When you are paying $0 in commission and the app is totally free, then like Facebook, like Google, then you become the product. And in this case, the flow of the orders, they are capitalizing from that somehow. You are definitely still paying a form of a commission one way or the other. So the app RobinHood, which was the primary way that many of the Wall Street Bets investors were purchasing the stock, restricted purchases. And this is likely something that was worked out between them and the big hedge funds that were suffering. It's very possible that Citadel owns a piece of RobinHood, etc. I am definitely not above telling you that there were shenanigans involved that were meant to throttle, again, the momentum of the purchases, because this is psychological. You see the stock rising and you want to participate, and the moment that you cannot, the moment you're just like taking the oxygen away from the fire. And this, of course, therein stops the fire from burning and actually starts to put it out. So what's going to happen now? I hate to tell you this, but the stock is going to fall back to what it's worth. That's the way that markets operate. This is their function. And people can tell you about their dreams of destroying a hedge fund, but when tens of thousands of dollars or even more is in front of them, and all they have to do is press a little button in order to put that into their bank account and pay off their bills, game theory holds. No matter how loudly they yell, hold the line, it becomes impossible to maintain that. Remember, no matter how much I'd like to avoid my son's tears because I sold off his beautiful marbles, we all have a price. So going forward, the hedge funds are definitely going to be changing their behavior. They're not going to allow themselves to be open to this much risk and exposure, knowing that a populist movement might come in and attempt to do this short squeeze again. So this is likely to be a one-off and is not necessarily going to be repeated. You can also look for legislatures to use this as an excuse to regulate the markets more and more. Maybe they're going to apply a transaction tax on each Wall Street trade to fill the government coffers so they can pay $10,000 to Robin DiAngelo for critical race theory training and further the poisoning of the United States. But that's my own editorial. Oh, and Steve Cohen, who they based the show Billions from, and his hedge fund Citadel are going to be the big winners in all this, unfortunately, both in terms of the equity that they were able to take from Melvin Capital in exchange for the loan, as well as what I'm assuming is still an enhanced position in the GameStop short position at prices that will inevitably crater back to what the company is actually worth as Redditors run away from holding their line to their bottom line and whatever profits they are able to pull out of this. Guys, if I did a good job explaining this, thumb it up, turn that like button blue. If you're new, subscribe. New content comes out almost every day.